All right. So, once again, intro to accounting. So, we're going to talk about everything that you need to know in this class. So, the introduction to accounting, what are you expected to learn in this class? So, here we're going to be looking at how the very basics, right? We're going to learn the how to collect, how to record, and how to journalize and post our transactions, okay? And then we're going to be looking at the accounting equation, all right? We're going to be taking a look at rules of GAAP and what GAAP does for us in order for us to be able to understand the rules and guidelines for us to be able to journalize a specific transaction, okay? And then as far as this class goes, we're going to be looking at a merchandise operation. So we're going to be looking at sales and inventory, all right, and revenues and how to purchase those kind of inventory and how to collect those sales and etc. Okay. And then of course we're going to also talk about creating financial statements and payroll. So here the end goal here is to give you a quick, summary or guidelines on how to just build a startup company. Um, these topics that we're going to be learning in class pretty much cover up the basics of how to run a small retail store. All right. So again, these are all the things that you need to know in order to produce financial statements, which allows us to look at profitability. But these are the basic rules or the very basics to get you up and starting a small business. Now, of course, what I mean by what I mean about starting a small business is that we're looking at a small business in general. We're not looking at corporate level because as we progress through accounting, corporate level is a lot more complicated. It's a little more advanced. However, they do share some of the same principles. There are huge differences though as we go through each chapter. There are things that I will tell you that a little are more for intermediate and advanced level of accounting. All right. But here we're just looking at very basic level of accounting where we're just trying to establish a small company or even work for a small private company. Okay, so here are the things that we're going to be looking at. And your book does cover all of these chapters, okay? But again, the lecture notes are exactly what I want you guys to focus more on because some of them are a little more elaborative than others, than the specific chapters are in your book, okay? So let's talk about the business organizations. Well, in order to start about talking about that, we need to understand the nature of the business, right? Pretty straightforward, right? It's basically the nature of the business is to, or it's an organization that uses resources, natural resources to create a product or a service. The ultimate goal, okay, of all businesses is to make money, all right? And we'll talk about the difference between the organizations, but however, every business is profit driven, as in the goal is to make money and to minimize costs, okay? So they would need to maximize their savings so that they can expand. They can take their dollar bill and they can expand it and multiply it across, generating that revenue. That's the ultimate goal of a business is to make the money, okay? So that's why it's very important that you do run your financial statements because it allows you to see how profitable you are and what your company is worth. So, once again, the nature of business is getting all those resources to create a product or service. Okay. Now, let's talk about there are 5 types of business organizations, okay? We're going to talk about sole proprietor, which is going to be our main focus of the entire class that throughout the next 15 weeks, we're going to be focusing on sole proprietors, okay? The next one we'll talk about is partnership. We're going to also talk about corporations. We're going to talk about limited liability companies and also nonprofit organizations, okay? So let's get started with the very first one. Sole proprietors. Okay, sole proprietor, right? If you break it down, sole meaning one, okay? All right, and that's exactly what most small businesses are. They usually start with one person, right? Or usually the person who starts their business is the owner of the business. And that's exactly how we see sole proprietors, is that the business and the owner are one. They're one and only, okay? Now, with that kind of ideal, right, that means the owner owns all the assets, liabilities, and earnings that the company makes, all right? Now, once again, if the owner and the business is one, you do need to know a few things about there. We'll talk about the advantages and disadvantages of a sole proprietor. But in this case, in the eye of the government, they view the owner and the business as one. So whatever happens to the business, the owner is responsible for everything that happens to that business. Now, here's a little fun fact here. So, of course, there's rules and guidelines on establishing a business, right? You can't just wake up one day and be like, I'm going to own a business, right? The IRS, or I guess the government, kind of gives like a control of how you could establish yourself as a sole proprietor. And that rule is that if you must make a profit, at least, all right? At least out of the 5 years, 3 of those years, you have to make a profit. If you do not, you will get recognized as a hobby, all right? Because when we learn about sole proprietors is that that's a huge tax write-off. And that's exactly why the IRS government is going to look down on you and make sure that you, as that sole person, isn't making a business just for the purpose of saving some taxes or having it as a tax write-off, all right? They want to ensure, so they're going to have you, again, submit all your financial forms. And if you do not make profits 3 out of the 5 years you are doing business, they'll automatically think that you're doing a hobby and they will tax you very heavily. Okay, so that's a very interesting rule, and I want you guys to know, keep that in mind, because once again, if you think owning a business is a huge tax write-off, think again, because you need to make a profit in order for you to sustain as a small sole proprietor business. Okay, if you don't, it becomes a hobby, and then all those taxes that you've written off will come back, right? So again, advantages and disadvantages. Let's start with the advantages first. Okay? So the very first and foremost is sole proprietors is the most easiest type of organization you can create. It is so easy to start up and it's so easy to close up as well. Okay? So what do you mean by starting up? It is as simple and easy as going to the, depending on what state you are, okay, here in Nevada, it's the Nevada Department, right? You go onto the website and you just sign up for a business license and file to the IRS as well as the local agency. And you have to pay, of course, a very small fee. I believe it's like $100 or so just to get a business license. About maybe 7 to 15 days later, you should receive your business license in your mail. That is that easy. It is that easy to start up a company. Okay? Well, of course, there are going to be looking at background checks such as your credit score to see if you are, in good standing with the government and filing taxes and whatnot, if you are able to own a business, or if you have too much liability, or if you owe too much to the government, they're not going to let you. They're not going to let you open up a business. Okay? So that is the number one thing. But however, it is that easy. You just go onto the website, sign up for a small business, or it's called doing business as. You sign up as a sole proprietor, and boom, it is that easy. Okay. Now, the second thing that is a good advantage is that the owner has full control and makes all the decisions to run the business. Now, if you've seen many companies that usually are typically like that have more than one person involved, it's kind of hard to manage a business, especially if you have to rely on making an executive decision together. Now, here, the best thing about is that if I want to say, go buy that, go buy this, pay for that, do this, this person can do it, right? If I say I want to hire 15 people, then that's how it goes. So the owner has full control to run and make all the decisions that are necessary to run the business. So therefore, this owner is not influenced by anybody else. They make all the executive decisions themselves. Okay? And that's a huge advantage, just because, once again, if you're dealing with multiple people, you'll never get a decision made if you guys do not agree. Okay? And then number 3, okay? Owners can keep or reinvest all profits and earnings from the company. So, as we will learn, because you and the business are one, therefore, any earnings, any revenues are going to be considered money that you could keep, you could pocket right away, okay? But usually for small businesses, okay, it's actually generally better to reinvest into your company, because you want to build your company. You don't want to take money away from your company and pocket all of that profit. Because if you reinvest into your company, right, you get to expand your company. You get to remodel your company, make a better menu, or make changes that could increase the revenue of your company. And the more that you do that, the more profits you'll be earning. And that way you could cut half and half to reinvest, and then half you could pocket. But you do have to know that as a sole proprietor or as a owner of a small business, you do need to keep in mind that the minute you make a profit, that doesn't, even though it is your money, but you should try to withstand or withhold your company by, making sure it has enough money to even function. You don't want to take money away, because then one day if you have a loss or something, right? You didn't earn enough money, then what are you going to have to do? Okay. So this right here means it's a good advantage, because that means the minute I make earnings or I make a profit, that money goes directly into your pocket. Okay? No questions asked. No, you don't even get taxed for it. Okay? Number 4, you could get personal tax deduction. So as I've mentioned this very, very briefly, since I am not a tax accountant, I cannot tell you the exact measurements or the exact criterias or what can you deduct as part of your taxes. Okay, I just know that that if you do own a business, right, you do get to take it off as a tax write-off. As you being a business owner, that is a pretty decent tax write-off. Okay. Now, if you are interested in taxation itself and wanting to know more about that, I would definitely recommend you go to irs.gov/publication 15. Publication 15 is more for the employee standpoint, but actually just go to irs.gov and you should be able to find all the information about how each organization is taxed. All right. Once again, we are not in a tax class, okay? This is financial accounting, but it is definitely good to know if you do one day plan on opening a small business or running or doing books for a small business that it is a personal tax write-off, okay? And then last but not least, it is also easy to dissolve. So again, we talked about easy to open. It's also easy to close. All you simply have to do is just close your bank account and boom, your business is dissolved. You have to also go to your government and local agency to inform them that you're no longer wanting to do operations. Now, of course, it does take a lot of money in order to form a business. So, uh, you know, especially if you're gonna choose to decide to dissolve it, that's a lot of money that you potentially pretty much lost into the company. But it is easy as that. You can dissolve it pretty quickly. It's almost instant. You just close your bank account and boom, you're good to go. You're done doing business. Okay. So those are the advantages of sole proprietors. Any questions?
No.
Okay. Now we're going to talk about disadvantages of sole proprietors. 100% responsible for paying any liabilities or any debt. So we talked about you and the owner are one entity, right? So therefore you are responsible for all the profits, all the assets, all the liabilities. So therefore that's a disadvantage because that means your personal assets are at risk. So if you own a business and your business decides to flop, the very first thing that they're going to do is they're going to go after your car, your home, your anything that's tangible, right? Your TV. They're going to go after it. And that's why that's one of the dangers of having a sole proprietor is that you and the company are one. So therefore, any assets that belong to the business obviously are going to go first, but that means all of your assets that belong to you are going to be at risk as well. Okay, because you are responsible to make those payments, and if you don't make those payments, especially for those loan sharks, they're going to come after you. They will never leave you alone. Okay, so that's 1 and 2, right? All of the businesses and the personal assets are at risk. So once again, if you think it's going to be great for you to take those profit earnings right when you start up your company to go buy yourself a fancy car, buy yourself a home, just know that that is up for collateral. All right? If your business flops, that's the very first thing that they're going to come after. Okay, so that is one thing that you need to be aware of and need to know. There is no waiver or there is no contract that you can sign that says, "Oh, I want to prevent this." No, you and the business are one. And as we progress down to the different organizations, then you'll see there are technically some ways that you can go about owning a business but not having the liability part, okay? Number 3 says limited to using personal savings or consumer loans. That is yes. So once again, when you're starting up your own business, it's only you and you alone. So therefore, if you have the money to start up the business, then go ahead and start it up, right? And you are limited to consumer loans. So if you've ever heard of startup, which is a loan, like a loan company, they actually their emphasis is to loan you some money to start up a company. That's exactly what it is. Okay, so yes, there are some consumer loans out there that you can partake in. But once again, if you borrow that money, you are responsible to pay it back. So if you took a $50,000 loan, you are obligated to pay that money back. And if not, they're going to go after everything that you've purchased either for the business, and then they go after your personal. Okay. So once again, usually these types of businesses, you actually would start off with your own money. You wouldn't start off right away with just a consumer loan. Ideally, you should put some of your money in there, just so that you know you can. It will look like you are able to manage the company, right? Number 4, does not attract high caliber employees. So when we go ahead and look into the employees section in this in accounting, we're going to learn that as you open up a small business, the one thing that you can't do is you're most likely not able to afford a 401k plan, health care. You can't provide for your employees, especially if you're going to start off very slow, right? Because usually the very first couple years of doing a small kind of type of business, you have to build your clientele, you have to build your customers, you have to build your brand. And that's probably one of the hardest things that you have to do. So as you build your brand, you're definitely going to have your losses more than profits, okay? So that's why that it's hard to hire those employees, because most employees are looking for a company to take care of them. And if the company can't take care of them, then they're most likely going to be a temporary worker, right? They're gonna work there for 6 months just to gain the experience, and then they're going to leave the company because you can't afford to protect them. You can't provide for them, especially Medicare, healthcare, whatever that a typical company could offer, right? You wouldn't be able to do it, because we'll take a look at this in chapter 12, that having employees are expensive, very expensive, especially if you're offering all these benefits and offering all these deductions. They are so expensive. And the one thing that you need to know is that when you run a business, your main goal is you need to be paying your employees off first, and then all liabilities come after. All right? Because these people, they come to work for you. They sign a contract or whatever it is, agreement. If they show up to your company, you are obligated to pay them for work. So, it's really unlikely that you will have a high caliber type of workers, people who are motivated to work for the company. So you're more likely to get those, inexperienced type of, low wage workers, people who just are trying to earn a couple bucks here and there, but they are not going to be permanent, because you can't offer them anything to help them, to want them to stay. Okay? But of course, that's not always completely true, because as you progress and build your company, of course, and once you get to that point where you can afford that, then this kind of, it's not as much as a disadvantage. However, the last part is going to be employee benefits are not fully deducted to the actual business. So once again, that's also a disadvantage, because even if you do have those small amounts to be able to afford those benefits for your employees, it's not always deductible to your taxes. Okay, so you may have to file double tax for having the benefits for the employees. So that's the disadvantages of having a sole proprietor or creating a sole proprietor. Any questions?
Not for me.
So once again, this class is going to be primarily focusing on sole proprietors or just small business companies only, okay? We're not going to be looking at corporations, because once again, that's a little advanced level of accounting. However, once again, we need to look at how a business even begins before we can even understand how a corporate runs, okay? So that's that, right? So the next section is going to be partnerships. Now, there are two types of partnerships, and then you'll see more commonly your LLPs, okay? But let's just talk about the two types of partnerships, right? We got a general partnership, and we have a limited liability partnership, or more commonly known as LLPs, right? You should probably see this more often than a general partnership, okay? Now, what is the difference between the two? Well, a general partnership, okay, the criteria here is it has to be at least two or more people involved into the organization, two or more owners, okay? And how they partake as the ownership of the company is basically they split it in half, or whatever even amount that they can agree on, okay? Some could do 40 40 40 40 30. No, wait, 40 40, what am I talking about? 40 40 20. No, 30 30 40. There you go. 30 30 40. Some can go like that, okay? Now, when we talk about general partnership, that means that each partner has an equal say, an equal responsibility, or an equal share of the company. All right. So that's a general partnership, is that every single person that's involved that owns the company has equal everything. Okay. Including equal profits. Okay. So that means if they earn money, they get equal share of that money. Okay. Now, the difference between a general partnership and a limited liability partnership is that it is classified is that you do need to have at least two people. However, the difference here is that you need to have at least one general partnership, and then the other partnership will act as if they are a silent partner. Usually, those silent partners, their main goal as a partner is that they invest into the company. They are the investor. They're the one that brings it. They're the one that invests a bunch of their money. And the idea here is that one person is in control of the company. However, the partners only have bare minimum responsibilities because they're only responsible for just providing the money. So this is more commonly that you will see is a limited liability type of company, because in this case, right, you have one person who is the general partner that's running the show, while the other person is only limited to what their investment is, and they get to reap the profit. So they don't get to do anything, okay? And usually you'll see this more type of kind of business, right? You typically would see silent partners more often than general partners. Okay. So, yes. So the silent partner is only responsible for what they originally invested in the company, okay? And whatever profits and whatever agreements, but they have the minimum amount of responsibility, because the general partner is going to be fully responsible for everything that the partnership does, okay? The company does, okay? Any questions there?
So on limited liability, only how about if the company has debt or any sort of tax issue?
Well, okay, so if that's where's the case, usually the silent partner could go in and kind of resolve that. But if that's the case, then that's an agreement that they have to discuss upon each other to see if the owner, if you know, if the other partner needs to kind of like pay back the other partner. So we'll talk about agreements and the circumstances are in the next page. Okay, but usually you need to have at least one general partner. It's not, you can have 3 general partners and 1 silent partner. That's completely okay. But what I'm trying to say is that you need to have at least one person that's either running the whole show, and the rest of them typically usually are silent partners. They don't want to deal with doing the business. They just want to purely invest into the company and only reap the profits. Okay? That's usually what you would commonly see. Okay.
So this is not a kind of LLC, right?
I'm sorry, say that again. An NSC?
LLC, like
Okay. Okay, an LLC. We'll talk about that in the next couple slides over. They are completely 2 separate things.
okay.
Okay. So yes, usually you would see that you have a LLP and an LLC. They are 2 separate entities. An LLP, right, is a partnership, so 2 or more people are involved, but the idea is that you typically would have someone who's running the show and someone who's just there for pure investment. Okay. Now, we'll talk about limited liability company after corporations, but that's the general idea here, is that you still have people who own the company. That's a huge difference between an LLC and an LLP, is that these people actually own a part of the company. Okay. Any other questions? Okay, well, let's go ahead and dive right into the advantages and disadvantages. So first off, first advantage is, once again, it is also easy to establish. All right, same thing, same idea. You go to the website, you sign up for a business license, and you just submit a form that says that you want to establish a partnership. However, you need to sit down with your partner and make agreements, because this is the very, very, I guess, core of laying down the responsibilities, what profits are being split, and what each partner does. Because if you don't have that agreement, you'll run into those disagreements, and then it becomes a disadvantage because a partner can leave at any given time. So it's good that it's easy to start, but you also want to make sure that the person that you're doing the business with is someone you could trust, and also they are in it for the company itself. Okay, they're not in it for anything other more than trying to ruin your company or anything like that. Okay, so you want to make sure that that kind of person, right? You need to go into some kind of contractual agreement, because if you say this is a verbal agreement, it will come back at you. Okay, so you do need to sit down and discuss every single responsibility, all the profits, everything about the company, and go into a formal agreement between you and the partners. Okay, so it could take a lot of time before you guys can just go and submit. You can't just be like, hey, you and me, hey, you want to go ahead and start a company? All right, let's go. No, it doesn't. Technically, you can do that, but you will come into a lot of more problems later on in the future if you don't sit down and set an agreement. Okay, so once again, it's very easy to establish. Okay. Second is ability to raise funds. So because not only you are a person, your partner is another person. If you have 3 people, then you have 3 people running the business, right? So all 3 of you have the ability to raise the funds. So therefore, one person could be responsible for sales. They could be a sales representative, right? The other person could be the investor, like we talked about, the silent partner. And then the other person could be, looking into finding ways to get more money, right? So the ability to raise funds is very crucial because you have more than one person. We're splitting the responsibilities and they can all bring in money in different directions. So that is a huge advantage, especially if you're a sole proprietor. You and the business are only alone. So you're going to have to do all that work yourself. Where as a partnership, you and 2 or 3 other people can split that responsibility and be able to gain the money and the revenues that you need to build your company a lot quicker. All right. And then number 3, tax deductions for profits. Okay, yes. So as a partnership, right? It's because you're owning a business and you're not incorporated. All right, we'll talk about that later. Therefore, all the profits are deductions to you. All right, so it's a huge tax deduction. So because as a partnership, right, you're not incorporated and you're not running a massive, huge industry. So therefore, it is a tax deduction to you. All right, so that's a huge advantage. So once again, we talked about sole proprietors, right? They can use it as a tax write-off. Partnerships can also do it as a tax write-off as well. And then number 4, hiring employees that may become a potential partner. So this is very, very, very common to mom and pop shops, right? So mom and pop shops, right, if they don't have any, kin or any lines, like if they don't have any children, right, usually if they see a potential worker that works hard for the company or, they can't pass it down to anybody, then it's a potential that that worker that's worked there for so many years and prove that they're loyal or, prove that they are reliable, they could be a potential partner of the actual company. They could own a part of the company or they can become the company itself. So that's why it is very they're more likely to hire good employees because of that potential, right? If I hire you with the potential that I may pass this company to you, right? Then the person's going to be most likely inclined to want to work harder. But usually that's determined based on, how many years have they worked there, right? You can't be just someone that you just picked off the street that only worked there for a month. It usually comes with time, right? But you're more likely to hire high working or high quality type of workers because that's a huge incentive to to have part ownership of a company. Okay. Now the disadvantages, right? At the same time, I've told you before, right, that they are responsible for the partner's actions. So here's a fun fact. All right. Well, actually, let me explain this one first, and then I'll do the fun fact. They are responsible for every partner's decision. So if one partner decides to make a bad decision, you're gonna have to suffer along with him. All right, because you agreed to that bad decision. Now, again, if that happens, right, then again, the company, right, it's supposed to be an executive agreement between the whole entire partnership. You guys have to agree in order to make that decision. So if it's a bad decision, well, then all of you guys are responsible for making that bad decision. So if they decided to, invest in a huge project and that project to end up flopping, well, the whole company has to suffer because it was an executive decision that you guys all agreed to. Now, here's the fun fact. If there are 2 people, right, that are involved in a partnership, right, and they're general partners, and if one person, right, one partner decides to make an executive decision and the other partner does not know about it, the other partner that does not know about it can revoke that person's decision, okay, because there's no agreement. However, let's say there's a meeting going on, right, and there's only one person there because the other person's doing something else, and they make an executive decision, but the other partner knows about it, it is binding, meaning it will go through because both of the partners know about it and both of the partners agree on it. So therefore, it becomes binding and it goes through. So that's a little fun fact for you. So in case you go into a partnership with a really bad person or really like you don't think they could run the company, but you're still partners with them and they make bad decisions, you can revoke their decision if they make a decision without you knowing. All right? But if you knew about it and you disagree on it, they could still go forth it because you know about it. Okay? So that's a little fun fact there. Profits are shared. Yes. So depending on how many partners you have, right? If you have 3 or more partners, then all the profits that you earn are going to be divided. All right? And that's a disadvantage because once again, as a owner of the company, you want the maximum profits. You want to pocket all that money to yourself. However, if you go into agreement with your partners, right? If it's 30-30-40, then you're going to either get 40 or 30% of the profits. That's it. It's split in the agreement that you've signed on what your profits is. Now, most cases that you should do as a small business is if you are starting up small as a partnership, you do generally would want to reinvest into your company. Usually that's just general rule of thumb. You don't want your business to flop right away. You want to continue, striving for letting the company live as long as it can. But usually profits, again, if you're the investor that invested all the money in there, your only main goal there is just to reap all of the profits. So you could probably take your share of the profits. Okay. And then number 3, disagreements. Yes, as we mentioned before, if you don't make your agreements, you will come into disagreements. And when disagreements, become bigger, right? Then there's a potential that that a partner could leave the company. Okay, so whatever disagreement it is, usually you guys are gonna have to find a way to either compromise. But most disagreements, right? Because maybe one person's more headstrong than the other. Maybe the other person doesn't really care about the company. They just care about making the money, right? So these agreements or disagreements could potentially be bad for the company because it could cause the company to end at any given point. Okay, so that is a disadvantage that unfortunately you need to have an agreement with the partners that you are associated that are owning this company, right? You need to agree, and if you don't agree, then you're gonna have to find some kind of way to compromise. Okay? Number 4, some employee benefits are non-deductions to the business. So once again, very similar to sole proprietors, right? Some of them, like some benefits, you're not able to deduct it from your taxes. So that's a disadvantage once again. And then last but not least, number 5 is limited life if a partner leaves, okay? So that's exactly why most cases, if a partner does leave, and if you want to sustain or remain as a partnership, you need to go look for those investors. You need to look for those silent partners, okay? And that's the dangerous right there, is that if you do go into an agreement with a partner, the possibilities if those disagreements or if that person just isn't motivated anymore, doesn't want to own a part of the business, and they want to just leave, then then the partnership will crumble, like it will disappear, because you can't be a partnership if you only have one person, right? But if you have multiple people, then obviously that won't be a problem, but you have to have more than one person own the company, right?
I'm sorry,
Yes,
I have a question,
go
Miss
ahead.
Kim.
Uh-huh.
Um, can any of this result in court? I mean, like if the partner is saying one thing and you're saying another, and you don't have any proof or anything, can any of this wind up like in court hearings and stuff?
Oh, absolutely. Absolutely. There's a lot of cases where, especially limited liability partners, right? Yeah, mostly they're like law firms. They actually would sue each other because of failure to agree, or what is it? If the partner decides to infiltrate, or they try to make these decisions without you knowing, of course, that is 100% plausible. Yes, happens all the time, especially with partners, especially when you're dealing with partners who, um, I don't want to say this, but usually partners that like are friends with each other are typically the people who kind of do those kind of things. Where, if you have a partner who's like your husband or your wife or something, your disagreements could fall under the part if you to end up divorcing or leaving each other. But it's not as massive as someone like, trying to pull the rug under you, right? Trying to steal money from you, or trying to make all these executive decisions without you knowing. So those kind of cases, yes, you can pull someone into court for that. And if that's the case, usually what happens is that the company either gets split in half, or someone takes the company and then the other partner takes that money from the court and build their own company. And usually that does happen. Yes. All right. Any other questions?
No, not for me. That right there was like wow.
Yes. So
Okay.
yes, so that's why if you're gonna try to go into a partnership, you need to make sure that the person that you are working with or partnering with is someone you could trust and be, responsible, reliable, whatever it is. But once again, we're all human, so you
And you
never
have to
know.
make sure that everything is documented, even though they're your partner, your friend, your buddy, or whatever. You still have to look at the business side and make sure that you CYA.
Absolutely. And that's why proof of a transaction is very important. And we'll actually take a look at that in chapter 3 when we look at transaction analysis. Proof of a transaction is very important. Okay. All
Got it.
right.
Thank you.
Yeah, of course. So, next entity that we're going to be looking at is going to be corporations. So, a corporation, right, is an organization. However, they have 4 characteristics that make it a corporation. And what those are is number 1, shareholders are limited to their are basically they're limited liabilities. So shareholders, right? So we understand shareholders as, you're owning a part of the company. However, here's what one thing that you need to know. The business itself and the shareholders are 2 separate entities. Okay? The corporation, right? Once you incorporate, okay, so here's a fun fact here. So in order for you to actually reach that corporate status, right? You need a few things. You need to be able to share ownership with more than 5 people, right? You need to be able to make it on a public platform and let the whole public be able to own a part of the company. So that is the determining factor, is why shareholders are a thing, okay? However, when you incorporate a company, right, it's going to actually be based on the state that the headquarters are in, okay? And usually wherever you establish your company. So as far as if you start off very slow, if you start off as a partnership or a, sole proprietor, right? Eventually it comes with time. Time for you to build your brand, build your company, get your company recognized. Once you've built it enough, and you decide to file to the state that you want to go into incorporate status, that's where all of these 4 characteristics need to happen, because then you are sacrificing yourself as the ownership of the company to let other people own a part of the company as well. Now, of course, with this rule here is that if you do become incorporate status and become a corporation, your shareholders are only limited to their investment, meaning none of their personal assets are affected. It's only with the amount that they invest. So if you ever looked at the stock market, right, and you want to own shares of a company, you're only responsible for the money that you own. So if I put $100 in Target, I only own $100 of Target. Nothing else. They can't come after me if I buy a car. They can't come after me. But if they take a huge loss, then I lose my $100 that I invested in Target. That's it. Simple as that. So that's one thing here, that the business itself and the shareholders that own it are 2 completely separate people. And that means the business itself is fully responsible for whatever happens to it, but the shareholders do not get affected. But that's the criteria here, is that not only one person owns it, but a bunch of people own it. And they own it through stocks or shares. Okay. So number 2 is going to have a central kind of management. So most cases, right, shareholders will elect people to run the entity. They'll run the business. So of course, if you ever heard of board of directors, right? I think that's like the only one, a committee board, anything like that. But usually the board of directors, right, usually would have like the president, the CEO, the CFO, the executive vice president, et cetera, right? Executive president of sales management, I don't know. They have a lot of positions under corporations. So once again, if what the shareholders do is they do elect these kind of individuals, because even though they own a part of the company, you know, if no one's going to be able to run the company, then what's the point of owning the company? Because no one's doing the operations behind the scenes. So they elect these kind of individuals to go ahead and be to run the business. Okay. And then number 3 is going to be transferability of shares. So once again, distributing profits through dividends. So if you own stocks, right, and if a company makes an executive decision, so again, the board of directors is going to be the one that makes the decision whether they want to take that profit that they earned, either reinvest into the company or divide it amongst the shareholders. So in this case, transferability of distributing profits is through dividends. Okay, so most cases, like of course, if you have like a major corporation such as Target, right? They have over 1 million holders, right? You can imagine that if they decide to split their profits and give everybody their money back, right, because they invested into the company, right? You could probably only get like $1 or $5 or even $10 at most, because you're dividing that profit amongst 1 million other people who own them as well. And of course, the amount of profit or the amount of shareholders that you own will determine how much percentage of the profit you get. So if someone like me only put $100 into Target, then I'm probably going to expect maybe 10 cents back. Where if someone owns like $200 or like at least $2,000 in there, they're probably going to get $10 out of it. So distributing it's very easily, but once again, it has to be an executive decision from the board of directors to split the profits through dividends. And then last but not least, number 4 is continuality of life. Even if there's only one shareholder, the life of the entity will continue living on. Okay, so even if shareholders die, right, or they did become deceased, right, the company's still going to live on because the entity is separate from its shareholders. However, there's only one criteria. You must have at least one shareholder for the corporation to still exist. If that last person decides to leave the corporation or sell their stocks, right, then they're going to just shut down the company itself. All right. So these are the 4 criteria that you need to have. 1, shareholders. 2, some kind of central management. 3, some way to transfer the funds. And lastly, a continuality of life, even beyond if there's only one shareholder left. Okay. So, yes. So let's talk about the advantages and disadvantages of corporations. So first off, advantage is going to be shareholders have limited liability. So once again, we can own a part of a corporation. However, we're only responsible for whatever amount of money that we invested in there. So again, if it's personal to you that you invested $5,000 and that corporation just plummets, well, you know, you lost $5,000. However, everything else that you own is still intact. You still own it. It's just whatever money that you invested to the company is going to be subject to be at risk. Okay? So that's a huge advantage because, once again, nobody wants to have their personal assets be at risk. They don't want their stuff that they own to be taken away, right? They just want to have limited liability. Okay. Number 2, shareholders are only held accountable for their investment into the company. So again, that's part of 1. Okay, that they have limited liability and that they're only limited to their original investment. Number 3, raising additional funds through sale of stock. So yes, when a company needs more money or when a corporation needs more money, they just simply sell stocks. All right. Now, a good way to entice your potential investors, is by selling short stocks, okay, or a twofer, right? Have you ever owned stocks, right? There's deals that you can have where if a corporation needs money quickly, right? They just sell their stocks and say, hey, we can let you own 2 stocks for the price of 1 stock. Right? They'll try to entice you in a way to, have means to collect money from you a lot quicker by saying, hey, here's a deal. You could buy 5 stocks from me for the price of 1, right? That's called a stock split. Okay? Yes, you can do that. And that's how corporations generate money, is that they just sell stocks. And of course, with the stock market, right, there's always new investors. Always, year round. There's always new investors that are looking into specific, companies. Especially if Target one day decides to do something like a promotional sale or something that causes them to skyrocket their profits. Everybody then wants to have a piece of Target, right? Everyone wants to own a piece of Target. So they end up trading and buying stocks, right? Because they know that there'll be a potential increase in profits. So people want to try to hone in on that. So with that being said, right, it is very easy for any corporation to make money by selling stock. Number 4, tax deductions for having employees. Yes, okay. They do get a huge tax break for having employees. And we'll talk a little more about that when we dive into chapter 12. But yes, it is a huge tax deduction because as a corporation, right, there are rules and guidelines on what you can be taxed at, and that's exactly what the next bullet point is going to be. So here it says, can elect to be taxed as S corporation. Now, There is no real difference between a C Corp and an S Corp. The only difference is based on how they're taxed. They're not separate entities. No, no, no. There's no such thing as a C. You can't just be a C Corp and then be an S Corp later on. Well, actually, yes, you can. But what I mean is you can't, when we're looking at a corporation, it's not like you could be one or the other. Okay, it's the only determining factor between the two is based on how you're being taxed. So in the eyes of the IRS, you could be taxed as a C corp or an S corp. All right, but in the public eye, you're just a regular corporation. Okay, there is no real difference between a C corp or an S corp except for the fact that how you're getting taxed. So as an S corp, all right, so we'll go off a little tangent here. As an S corp, you can be taxed like a partnership, right? You only get taxed at the personal income level. So therefore, if you disperse your stocks or your dividends, you get taxed on that. Okay. Whereas a C corp or C corporation, right? You are getting taxed twice. You're getting taxed at the personal level, and then you get a corporate tax level. All right. So those could be very, very hefty depending on how much ownership you own. Okay. So once again, they're not two separate entities. They are the one entity. It's just the difference between how you're being taxed is what is the difference of titles. Okay. So being taxed at an S corp is definitely a lot more better, right? Who wants to be taxed twice by the government, right? You're already being taxed once is already heavy enough. But yes, as a corporation, you can elect as an S corp. Now, of course, if you do that, you're just subject to have higher taxes because you're lucking out on that extra tax, right? So you will be paying higher taxes because you're being elected as an S corp. All right. But that is a huge advantage because who wants to be taxed twice, right? Now, disadvantages here are going to be it requires a lot of time and money to create or establish a corporation. So as we talked before, right? You could start off as a small business, as a sole proprietor, as or a small partnership, right? But if you want to become in corporate status, right? It takes time because you not only do have to build your brand, you have to build your product, you have to be recognized by the public. If people know you for the quality of your service, then that's where you start climbing into the ladder because then people would want to invest in you. And once you get that following, right? That's when if you do decide to establish corporate status by going to the state, then people who do want to invest into you can do so. But of course, that takes a long time. If you guys remember, it took I don't remember when, but I know Target was established back in 1940 or something like that. Took them a long time, but they, built their brand. You know them as they are now, right? They're a huge corporation, a billion-dollar company, but imagine how long. They were just a small shop that just sold convenience items, right? And look at them now. They've expanded to the point where they're a part grocery, part this, part that, okay? So once again, you have to start somewhere and then you can build yourself to become a corporate status. So again, that is a disadvantage because you can't just you can't just go and apply as corporate status if you don't have the money. And especially if you're not well known. Right? You will definitely plummet very hard. But that doesn't mean you can apply for corporate status. Yes, you can. You just go through the website once again. It just establishes yourself as corporate status. However, you definitely need a lot of money and you definitely need people who are willing and wanting to take part in your company. Okay. All right. Number 2. All right. Monitored by the federal, state, and local agencies. Yes. Yes. Okay. We'll talk about this towards the end of chapter 1, is talking about the Sarbanes-Oxley Act. Okay. If you guys remember who Enron is, they were one of the corporations that frauded the government to the point where now we need to have the government involved in everything that the corporation needs to do. So that's a huge disadvantage because you can't run the company the way that you want to run the company, especially knowing that, we elect our board of directors. They can't just do whatever they like. It's all being monitored by the federal government, the local agencies, whatever it is. They're being looked at through a microscope. So every decision that they make has to be very well thought out and cannot, they have to run the business very carefully, right? Because once again, if they try to cheat the IRS, they can get heavily fined. They can even be terminated. Okay, so they're highly monitored by, all the activities are monitored by the federal and the local state agencies. Okay. And then last but not least, number 3, high taxes are taxed twice. So once again, we talked about C Corp. C Corp, that means there are some circumstances of how you can establish yourself as an S Corp. But most cases, if you don't, you're automatically taxed twice, at the corporate level and the personal income level. Right? Any questions about corporations? Okay. I will let you know it is way more complicated than just this right here. Any questions? All right. Okay, so now we're going to talk about limited liability companies. So these do cease to exist they're pretty common here. Okay, now what is an LLC? It is a hybrid between a corporation and a partnership. So hopefully this answers your question, Nathan. So this is where you can go into a partnership. However, you can partake in some things that corporate statuses can. All right. So it is not a corporation, but it is a legal entity that acts like a corporation, but it is a partnership. Okay. So we talked a little about the difference between a limited liability partnership and the difference between a limited liability company. The difference here is that you have 2 components of a corporation. So therefore, as a partnership, right, you can own the company. However, you could be a legally publicly traded company, meaning you can have stock or you can have stock for people to want to invest in your company. Yes, that is a characteristic of a corporation. So let's go ahead and review it. You can have a central government if you'd like, right? Or separate or something like that. You can have any means to distribute your profits, right? But in this case, we call them members for LLCs. Instead of stockholders, they're members, okay? And once again, you and the entity are 2 separate things, right? A limited liability company and its owners are 2 separate companies. Okay, so one of the 2 of the 4 characteristics will be, you could choose which one. It doesn't have to be specific ones, but it is a partnership that is in combination part corporation, and that's the difference between a limited liability company. So therefore, that means any partner that invests into that is a part that owns the company, they are not liable for anything except for their investment. All right, and here we are. First thing here is the advantages of establishing a limited liability company. First one is that you can be taxed at you know, corporate level. Okay, so meaning that you could establish yourself either as C corp or S corp. Most cases, you're going to go for an S corp, right? So it's your taxation here is flexible. So most cases, limited liability companies are more likely they have the option to choose to be taxed at corporate level, whether it's C corp or S corp. But most cases they'll go for S corp. Number 2 is limited liability. So once again, any partners or any members that are involved are only limited to whatever investment they are, whatever stocks that they own, right? That's it. Number 3, all right, can elect one member to be the entity. So if you did your reading, right, what they mean about being the entity is they're just going to be the sole, or they act as if they're the general partnership. And this membership can be transferable, as in like maybe 1 year you could elect one person to be the president or the owner of the business, and then the next year you can elect the next person to be the owner of the business. So transferability is possible and very easy. Okay, but once again, you're not subject to be responsible for anything except for whatever you invest into the company. But when we talk about members, right? Members of the entity, meaning the people who own the company, right? People who belong to the company, I guess, if you want to think of it that way. They can, they can act as if they're the company, or they can choose to, be a silent partner, right? Not care about the company, but only care about whatever they invest in there. Okay? Number 4, no annual shareholders meetings required. So because this one, right, its members are its memberships, not technically actual shareholders, right? There is no requirement because I guess the limited liability company, they're a lot smaller than a corporation. They're not as massive, okay? So therefore, they don't need to have those shareholders meeting because the shareholders themselves are members. They're the ones that's running the company. So there's the difference here is that instead of relying on a little central government or electing a small board of directors to run the company, they themselves run the company. Okay. And then number 5, least administrative work and record keeping. So again, this has to do with like filing for those documents and things like that. It's less work. Okay. And then number 6, memberships interest can be assigned. So we talked about transferring, right? You can't assign a specific person. Hey, you're gonna be the owner for the entity this year. All right. And once again, it's easy to transfer the titles over without having that. Or in this case, this one goes along for profitability, right? Maybe this year you take all the profits, right? Memberships can be assigned, right? Excuse me. Okay, so that's the advantages of being a limited liability company. Now, what are the disadvantages? Well, let's talk about the first one. At least 2 owners or members. So therefore, you can't be one person being this because once again, this is partnership, right? It's half a corporation and a half of a partnership combined together to create a limited liability company. So therefore, the rule is in order to establish yourself as a partnership, you need to have 2 or more people. You can't be one sole person to become a partnership. You need to have at least two. So there's the disadvantage there is because you can't establish yourself as a limited liability company if you're only one person. Okay. Number two, can have limited lifespan. So once again, if your partner decides to leave, therefore, your business is done for, unless you find someone else. Okay. Number three, okay, may have self-employment taxes. So when we look at how this type of business works, once again, you're going to learn that you can write off the taxes as a self-employed tax, but because you're a partnership. However, some of them can be deductible, some of them can't be, depending on what kind of status you are. So as a limited liability company, right, you can't really write that off because you're kind of part corporation. All right. So therefore, that's kind of a disadvantage. Once again, you want to learn more about that? IRS.gov. Right? And then number 4 says if profits exceed 50%, it will be taxed by the federal. So once again, we talked about disadvantages of corporation. They're being watched by the federal government. So if a limited liability is part corporation, you're going to get the same aspect that they're going to be boggled, they're going to be looked upon by the federal government. So here, if profits exceed 50% or more, you will get taxed by the government. Right? And then cannot take advantage of stock options. Yes, this is something that you need to know. As a corporation, and if you're the president of the company, you can own stocks. As a limited liability company, you cannot take advantage of stock options. Now, again, stock options could be meant for if you choose to leave the company at any given time, then you have the options to take advantage of stocks options where you still own part of the company, but you don't work for the company. In this case, you can't do that. Not in LLCs, because potentially you can be part of the company, like actually work for the company. So therefore, you can't own the company and take advantage of it after you leave. Okay. And here, some states actually tax LLCs. So you definitely need to make sure that you do your research on, especially when you're looking into where you want to establish your company. You're right, whether it's here in Vegas or here in Nevada, you could be taxed, right? California, Georgia, wherever. Okay, you can be taxed. It just depends on where you just have to do your research and make sure that if you do establish yourself as an LLC, that you understand what all those taxes are meant for. So you definitely need to go to the IRS.gov, and whatever state agency that you are planning to do your business in, you want to make sure you know all the rules and all the regulations as well as all the taxes that you're subject to have to pay. Okay? And then, of course, when you are converting an existing business into an LLC, so as we talked about this before, right? In order to become corporate status, you have to kind of slowly build your way up. This is the same idea, right? If you're going from a partnership and you want to establish LLC status, you can get taxed for that. Okay? Once again, you must start from somewhere before you can become these kind of ideas. You can't just start away as a LLC right away because this is a combination between a partnership and a corporation. You do unfortunately need to build your brand and then establish and convert into an LLC. Right? Any questions in regards to limited liability companies? Okay. Last but not least, we're going to go over this real quick and then we'll take a break. Okay. Last but not least, the last type of business or organization is going to be non-profit organizations, or also known as non-for-profit, whatever way that you know non-profit organizations. These type of organizations only have one goal, and that is either share um, a type of view, educate. They could be for cultural type of organization. They could be a professional organization, but their main goal is to educate. All right, and provide public services. Okay, and they are purely voluntary. Okay, so many type of these organizations are usually the charities, voluntary organizations, maybe like a go green type of organization, anything that kind of those kind of organizations. Now they are non-for-profit or non-profit, meaning their goal is not to make money. Their goal is to educate, or their goal is to spread awareness, cultural appropriation. Okay, maybe they're a professional organization, right? Maybe they're they have some kind of goal to spread awareness, or to go for cancer research, such as the St. Jude's, right? So here are very many popular types of organizations, right? We got PETA, not us PETA, but the animal PETA. Okay, we got Comic Relief, which is for AIDS and HIV. We have Susan G. Komen, which is breast cancer. And we also have the St. Jude's, right? These organizations, right, they're not in it to make money for making money. They're in there to spread awareness, or some kind of cultural, or some kind of idea. And they're just letting and educating everybody out there, okay? So once again, there is no owner because it is pure voluntary. Okay, whoever wants to be part of the group, they have to they're subject to have to pay a membership fee, or a membership due. And usually that's what runs the business. Okay, is that because of their ideas of trying to spread awareness, or trying to contribute to society by educating. What they're mainly focused on, or their means of getting funded, is usually through either generous donations by corporations, contributions, even donations from other people, fundraisers, membership dues. So most often you'll see a lot of these organizations, for example, the LA AIDS Walk, right? That's a huge organization that brings together anybody that has those organizations that spread awareness about HIV and stuff. They get sponsored by those major corporations, such as like AT&T, anybody that is a major corporation that want to sponsor it. And usually those kind of companies would either donate to them, or they would, contribute, like send them a big fat check. Because, again, when you're doing corporation, you're going to learn that there's a small aspect that you need to do. You need to contribute to society, because as a corporation, you need to look good in the public eye too. So they usually, hone in on trying to invest into these nonprofit organizations, or sponsor them to make them look good as a company, but also, to help these organizations run their business. They need money in order for them to set up these organizations, right? Or they need money to, buy the materials, to buy marketing material, right? Have those t-shirts, have donations. They do this for the purposes of just spreading awareness, okay? Now, again, these kind of organizations have a completely different taxation process, okay? Because they're non-for-profit. They're not there to gain money. So they get special taxes, which, once again, I'm not an expert on taxes. I'm just a regular accountant, not a tax accountant. So once again, those special taxes are going to be something that you, if you do end up creating or wanting to be part of a nonprofit organization, you do want to check out the irs.gov to know more about what taxes, what special taxes are you subject to partake in. So again, non-for-profit organizations are pretty common. You know them as they are, the ones that spread those kind of awareness, educational, cultural, whatever it is. Okay. So any questions in regards to the 5 different business organizations that we got to take a look at today?
So do you know anything about PLC?
Say that again. PLC.
Yeah, that is something that, I mean, we use PLC like LLC, I guess.
Okay, so yes, that's in the reading that you guys got to take a look at. Okay, sorry about that. But yes, that is in the reading that you got to take a look at. But once again, we're not looking into details of a specifics of those corporations or those kind of entities. We're just taking a look at just general information. If you want to learn more about it, I would definitely refer you to go to irs.gov because they also give you an outline of every single kind of business out there.
Okay.
Okay, but for this class, we're just only learning very basics. We're not, because the main priority of this class is you just need to know that these type of businesses exist. But we're going to be learning sole proprietor. Okay, so PLLCs. Okay, if you want more information about that, like I said, irs.gov, or you can even look it up online in general. All right. Any other questions?
No, I'm good.
Okay. So once again, it is now close to 10 o'clock. It's about 9:58. So what I'm going to do is let's go ahead and take a break.